This is a much more involved calculation, but if you have watched some of my previous videos, the concept of NPV is still the same. There's much more information, and now we are comparing two investments. So let's go with the question. So Fantasy Limited is a South African-based manufacturer of football jerseys. The company is currently investigating two investment projects. The information is provided below. So we have project one. So we have project one, which involves extending the company's production facility at Sherwood in KwaZulu-Natal. Project two involves setting up an independent manufacturing facility in Taiwan. So what are we expected to do? If we go here to the bottom, we are required to compute the necessary calculations and advise funders limited if it is worth investing in either of the two opportunities. So what I've done here, I've created, to make it easier to explain, I've created two tabs, as you can see here at the bottom, for investment in KwaZulu-Natal and investment in Taiwan. So if we go to investment in KwaZulu-Natal, so I only have now information for Project United. So it involves extending the company's manufacturing plant, which will cost 250 million. So the cost of the plant, 250 million, I put it there. Annual profit of 75 million. So I said annual profits would be 75 million. You can see I put it there. And we know the life of the project is 7 years, we are told here. The following expenses were included in this 65 million. Depreciation was calculated on a straight line basis over the life of the plant. So we know that the depreciation is on the plant. So we say 250 million divided by 7 to get the annual depreciation. So we have it there. So if you look at the formula bar, in the formula bar, there you can see 250 million divided by 7. Then we are told share of overhead expenses borne by the head office is 50,000 per month. So we want to find the annual overhead will be then 50,000 times 12, which is, 50,000 times 12 is 600,000. So to get the annual cash flow, we say 65 million in annual profits plus 35,714,385 in depreciation, because remember depreciation is not a cash flow item, so we have to add it back. Then less the overhead, it gives you a total cash flow of 100.114, which is the total annual cash flow. Let's actually bold it so that it's clear. So now we want to see, so over 7 years, we want to find what is the actual NPV over 7 years, because this is what it's paying per year. So we go to the table, to the present value interest factor table at the back of your module. And we are looking for 13% in 7 years. What factor are we going to find there? So we go there nicely, 13% in 7 years. Where they meet, we have 4.4226. That's the factor you are seeing here, 4.4226. Now we multiply that times that. So we know that the present value of all the future cash flows, of the future cash inflows, is 100 times 4.4226, which gives you 442.765440. So to get the NPV, now we need to subtract the initial investment, which is the 250. So we now say 442.765 million minus 250, it gives you 192. So this is good. This is positive NPV for project one. Now we need to go and see if the Taiwanese plan also gives what NPV is. It also positive. So if we come to the NPV for Project Taiwan, we are told involves setting up an independent in Taiwan. The cost of the facility would be an initial outlay of 300 million Taiwanese dollars. So cost of the facility, 300 million, which would result in annual sales of 112 million. So annual sales, 112, that's income for 7 years. So it's also a 7-year project. The annual fixed cost and variable costs are 12.2 million, that's fixed cost, and 9890 Taiwanese dollars, that's variable cost. So we say fixed cost 12.2, variable cost 9.98. So the total annual inflow is that minus that minus that. which gives us 89.91 million. Now let's look at something a little bit new. So if you come here, you're told Funders limited current cost of capital is 13%. The spot rate, let's not worry about that. The Taiwanese inflation is expected to exceed the South African inflation by 3%. So the Taiwanese inflation is actually higher than the South African inflation. So you then say 13, which is the current cost of capital, plus the 3%, which is the additional, which would come from excess inflation, which gives you 16%. So now we are going to look at 16% over 7 years in the present value interest factor of an annuity table. So it's 16% in 7 years. If we come to our back of the module, 16% in 7 years, you can see here it is 4.0386. So that's the number which you have here. So now I say annual cash inflow times that gives you 363. 110,526 million. That's the inflow. So the NPV becomes 363,110 minus the 300 million, which gives you 63,110,526. These are still Taiwanese dollars. But we want to compare with the South African project. So we need to convert the Taiwanese dollars into rands. So we come back to our question. So we see in line number 11 here, the spot exchange rate is 6.2 Taiwanese dollars to the rand, which means the rand is more valuable. So we multiply this 63110 times 6.2, which gives us 391, 285, 261.0. That's a big number. The good thing is it's a positive NPV, which means in this case, if it was only this project, we would simply say invest. But since we have two projects, we need to make a recommendation of one of them. So we go back to our initial tab where we have the full question into the full answer. So you can see investing locally gives you 176 million, 176.8 million. Investing in Taiwan gives you 391. Both are acceptable. But then you can say in your answer, in your advice to Funders Limited, both investments are viable as NPV is positive. But we will accept this one, setting up an independent manufacturing plant in Taiwan, that one. Why? Because the NPV is higher, which suggests that it will make more money than investing locally. If you do this and present it very clearly, you get your 25 out of 25. You already have the quarter of the marks in the exam, so a distinction will be on your way.